always starts at the Strait of Hormuz, but focusing exclusively on that single waterway leaves a massive geopolitical vulnerability completely unchecked. Look at the Bab el-Mandeb Strait. It sits directly between Yemen and the African coast, acting as the primary gate connecting the Red Sea to the open ocean. While Hormuz is primarily an energy corridor, Bab el-Mandeb carries the physical economy. Millions of tons of raw materials, finished retail goods, and heavy container shipping flow through here daily. A massive percentage of all trade moving between European and Asian markets relies entirely on this narrow passage to maintain their precise delivery schedules. It is the structural backbone of global commerce itself. Regional tensions, particularly Iran's extending sphere of influence near Yemen, mean that the area surrounding Bab el-Mandeb is highly volatile. This map shows how Hormuz and Bab el-Mandeb operate as connected nodes on a single global trade network. Instability in one easily ripples to the other. If both of these nodes constrict at the exact same time, the entire east-to-west transit system fails. Logistics companies cannot afford to park their fleets and wait for geopolitical tensions to cool down. They are forced to abandon the route entirely to keep their cargo moving. That local tension forces operators to physically tear up their standard timetables and completely redraw their global shipping routes. The only viable alternative is to point those massive vessels south and send them all the way around the southern tip of Africa. This chart shows the severe logistical penalty of that detour. A standard route is immediately extended by weeks of additional transit time. Adding thousands of miles requires hundreds of thousands of extra gallons of marine diesel per ship. At the same time, base freight rates and premiums for maritime insurance climb exponentially as the risk of the journey and length of the delay compound. When these delayed fleets finally arrive, they show up in massive clusters, completely overwhelming the destination ports and creating severe physical bottlenecks on the docks. That massive physical detour acts as a relentless multiplier on the fundamental cost of doing business. Shipping companies do not absorb these massive new operational expenses. They pass them straight down the supply chain. When inventory takes an extra 3 weeks to arrive, the resulting scarcity drives up the price tag on everyday retail items and household groceries. The sudden spike in demand for maritime fuel directly impacts the local supply, increasing the price you pay at the neighborhood gas pump. The ultimate result is a sudden, sticky rise in consumer inflation. Inflation is the general upward movement of prices for goods and services in an economy, reducing purchasing power over time. To combat those rising prices, central banks are forced to freeze or hike interest rates. A central bank is a national institution that manages a state's currency, money supply, and baseline interest rates. A localized shipping detour thousands of miles away directly dictates domestic monetary policy and how much it costs you to borrow money. A total, headline-grabbing closure of the strait is actually not the worst-case scenario. Global markets are historically resilient. They quickly adapt and recover from sudden temporary blockades by executing short-term emergency plans. But the real threat is actually chronic friction. Chronic friction is a state of prolonged operational uncertainty that bleeds the global system through constant lunch-level delays and creeping insurance premiums. In a hyper-connected economy, the sustained tightening of these two distant waterways acts as a permanent tax, silently reshaping the cost of daily life.